Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Crowdfunding has changed how people invest by letting them back projects they believe in, no matter how much they have to spend. Platforms like Kickstarter and GoFundMe let anyone with an internet connection support creative ideas, charitable causes, or even early-stage businesses. What started as a way for artists and entrepreneurs to raise small funds has turned into a global movement reshaping investment. These platforms offer a range of options, from donating to a cause to earning rewards or even equity in a startup. Whether you want to fund the next big tech gadget, help a local business grow, or support someone in need, crowdfunding makes it accessible. The variety means there's something for every investor, regardless of budget or interest. Interested in how it all works? Let's break it down. Understanding crowdfunding as an investment tool. Crowdfunding flips traditional investing on its head. Instead of dealing with banks or stock markets, it connects people directly with projects they care about. You're not just putting money into faceless funds, you're helping bring ideas to life. Better yet, most platforms let you start with just a few dollars. But not all crowdfunding works the same way. Some platforms let you own part of a business. Others send you early products. Some simply fund good causes. The right choice depends on what you want from your investment. Reward-based crowdfunding. Kickstarter. Kickstarter is the go-to for creative projects. Filmmakers, game developers, and inventors pitch directly to the public. In return for backing them, you get rewards, often the product itself. Here's how it works. A creator sets a funding goal and deadline. You pledge money toward that goal. If the project hits its target, your card gets charged, and you'll later receive the reward. If not, you pay nothing. The appeal. You get early access to cool gadgets, art, or experiences before anyone else. The downside. There's no financial return, just whatever perk you signed up for. Missed deadlines or failed projects can happen, so back creators with a solid track record. Equity-based crowdfunding. Platforms like Seed Invest. Equity crowdfunding is closer to traditional investing. Instead of rewards, you get actual shares in a startup. Platforms like Seed Invest and Crowdcube let you buy stakes in early-stage companies for as little as $100. You become a partial owner of the business. If the company grows, so does your investment. Unlike Kickstarter, startups here must follow strict financial regulations. It's riskier than buying stocks of established companies, but the potential payoff is higher. Just remember, most startups fail, so diversification is key. Donation-based crowdfunding, GoFundMe. GoFundMe isn't about making money. It's about pooling resources for causes. People raise funds for medical bills, emergencies, or community projects with no expectation of payback. Why donate? Immediate impact. You help someone directly. Transparency. You often see exactly where the money goes. No strings attached, but tax deductions are rare. Unlike reward or equity models, the return here is purely emotional. You won't get a product or ownership, but you might help change a life. Pros and cons of crowdfunding investments. Crowdfunding opens doors that traditional investing often keeps locked. It lets small investors back projects they love while giving entrepreneurs a way to raise capital without big institutions. But like any investment, it comes with trade-offs. Here's what works and what doesn't. Advantages for investors and entrepreneurs. For investors, crowdfunding offers 3 big perks. Low barriers to entry. You don't need thousands to start. Some platforms let you invest with just $10. Diverse options. Back a tech startup, a local bakery, or a documentary, all from one platform. Direct impact. Unlike stocks, you know exactly where your money goes. There's a story behind every dollar. For entrepreneurs, the benefits are just as clear. Faster funding. Skip bank loans and pitch directly to an engaged audience. Market validation. If your Kickstarter campaign flops, it's a sign to tweak the idea before wasting more cash. Community building. Backers often become loyal customers or brand advocates before the product even exists. The best part? Everyone gets a seat at the table. A retiree can invest in a friend's business. A college student can test demand for an app. No Wall Street experience required. Risks and challenges. Not all crowdfunding is rosy. Here's where things get shaky. High failure rates. Most startups fold. Even promising campaigns can collapse if the creator underestimates costs or delays production. Zero liquidity. Unlike stocks, you can't sell your stake mid-campaign. Your money is locked until the company goes public, which might never happen. Scams and missteps. Some creators exaggerate timelines or deliver subpar products. Platforms offer refunds, but the burden often falls on backers to chase them. Worse yet, equity crowdfunding lacks safeguards. If a company you backed goes under, you're last in line to recoup losses after banks and employees get paid. Still, smart investors mitigate risks by spreading small bets across multiple projects. Think of it like buying lottery tickets, but with better odds and a front row seat to innovation. The key? Never put in more than you can afford to lose. How to choose the right crowdfunding platform. Picking the right crowdfunding platform isn't just about fees. It's about finding the right audience, structure, and fit for your project. Whether you're raising money for a tech prototype, a social cause, or a startup, the platform you choose impacts everything from fundraising speed to back-end hassle. Platform fees and funding models. Not all platforms charge the same way. Some take a flat fee, others a percentage of funds raised. Then there's the fine print, transaction fees, payment processing costs, and penalties for missing your goal. Here's a quick breakdown. All or nothing. Kickstarter. If you don't hit your target, you get $0. But backers aren't charged, and fees, around 5%, only apply to successful campaigns. Keep what you raise, GoFundMe. You get the funds even if you fall short. Fees are higher, around 2.9% plus $30 per transaction, but it's better for urgent or flexible goals. Equity platforms, Seed Invest. These charge both upfront fees for due diligence and a cut of the funds raised, 5 to 10%. You're also dealing with SEC regulations. Tip. For creative projects with a clear budget, all or nothing works. For personal causes or flexible funding, keep what you raise removes pressure. Now that you've seen how crowdfunding platforms operate, get ready to explore the risks, rewards, and how to pick the right projects. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.